90-day US-China tariff pause. Who blinked first and what happens next? Overnight, import duties that had rocketed to 145% collapsed to barely a fifth of that. Beijing calls the climb down a step toward resolving differences, while Washington insists it proves tough tactics work. But who really blinked? And what does a 90-day pause in the trade war mean for businesses, consumers, and the global economy? This is Nexusfeed. Let's find out. Rewind to Tuesday, 2nd of April. Hoping to squeeze Beijing over fentanyl flows, President Trump invoked the National Emergencies Act and signed Executive Order 14257. Overnight, every Chinese import that wasn't deemed humanitarian picked up a 10% base duty, plus a 115-point national security surcharge. Beijing answered within hours, slapping an almost identical 125% levy on U.S. soybeans, liquefied natural gas, and high-end chips. Global markets gasped. The S&P 500 lost 4% in a single day, the yuan slid to a 19-month low, and the IMF shaved half a percentage point from its 2025 world growth forecast. By Friday, the United States had doubled down, boosting its ceiling to an eye-watering 145% on what little Chinese trade remained uncovered. Beijing, unwilling to appear weak, threatened rare earth export bans and hinted at a blacklist of unreliable American suppliers. Lobbyists on both sides began flooding lawmakers with the same plea: we cannot price a supply chain that changes every sunrise. Fast forward to Sunday night in Geneva. After 16 straight hours of shuttle diplomacy, U.S. Treasury Secretary Scott Bessent and Chinese Vice Premier He Lifeng emerged with a terse joint statement. Both sides would roll back their most aggressive tariffs for exactly 90 days. Starting 14th of May, Washington's levy drops from 145 to 30%, 10% base duty, plus a 20-point fentanyl surcharge, while Beijing cuts its own wall from 125 to 10%. The promise runs on a stopwatch. At 1 minute past midnight on day 91, every suspended duty comes roaring back automatically unless negotiators deliver a broader pact. Intellectual property theft, forced tech transfers, and industrial subsidies, the arguments that fueled this war, remain untouched. The deal simply buys both governments a long breath and prevents Wall Street from fainting again. So, which capital folded? On paper, the tariff rollbacks look symmetrical. Each side removes 115 percentage points. In practice, the hit is lopsided. China's exports are far more price-sensitive than America's, so a 30% barrier still hurts Guangdong's factory owners harder than a 10% duty hurts Midwestern farms. Currency screens tell a second story. The yuan leapt 1.2% against the dollar as soon as news broke, while U.S. equities sprinted to a 2-month high. Governments usually crave that kind of instant relief only when domestic pressure is acute. Then there's the rhetoric. President Trump hailed the truce as proof China is opening at last. President Xi merely called the talks constructive and chastised Washington for bullying. One leader is selling victory, the other, patience. The simplest reading says Washington blinked first. Runaway consumer inflation was turning into an election-year liability. Yet Beijing was hardly cruising. Factory gate deflation and coastal job loss protests had the Politburo sweating. In truth, both sides needed an off-ramp. American retailers are first in line to celebrate. Big box chains that bought spring inventory under punitive rates can now place summer orders at 30%, average their landed costs downward, and maybe shave the size of July price rises. Manufacturers who rely on Chinese inputs, HVAC units, power tools, EV battery casings, get a temporary lifeline to rebuild margins. Though procurement chiefs warn that 90 days is nowhere near enough time to shift factories or retool supply chains, the uncertainty tax lingers. Not every domestic player is smiling. Steel mini-mills and the handful of U.S. rare earth magnet makers that blossomed behind the tariff wall saw their share prices slide 4%. Nearshoring consultants, once billing hourly fees to shepherd clients into Vietnam or Mexico, are watching projects pause while CFOs hunt clarity. For households, the effect is small but welcome. Goldman Sachs reckons headline CPI could dip by 0.3 of a percentage point by late summer if the truce sticks, roughly $85 back in a typical family's wallet. Relief spread like an audible sigh across export powerhouses Guangdong and Zhejiang. The Kaizen Flash PMI, which had slipped below 50 for the first time in 3 years, popped back into expansion. Factory managers are now racing to push as many orders as possible through U.S. customs before the clock strikes midnight in August. The truce also unlocks long-frozen deals. Boeing deliveries to China, suspended since February, are suddenly back on the calendar, and American chipmakers once again have meetings confirmed in Beijing. Still, a 30% U.S. levy on consumer electronics wipes out the knife-edge margins of many Shenzhen gadget brands, forcing them to double down on factories in Vietnam, Thailand, or Mexico. Chinese consumers feel only moderate relief. American dairy, cosmetics, and fitness gear lose part of their tariff premium, but Beijing's 10% floor duty means shelf prices never quite return to pre-trade war levels. Markets all over the world embraced the ceasefire. The MSCI World Index climbed almost 2%. Brent crude dropped $2 a barrel as recession odds eased, and the VIX fear gauge slid 9 points. Bond traders, however, trimmed bets that the Federal Reserve will cut rates later this year. If tariff-induced disinflation fades, the central bank's job becomes that much tougher. Europe breathed easier because fewer Chinese manufacturers will need to dump excess stock in the EU. ASEAN capitals, meanwhile, worry that nearshoring cash might slow if American buyers reopen the China spigot too widely. Mexico frets that its embryonic EV supply chain could lose momentum should the United States decide it's easier to source again from Shenzhen. The IMF calculates that a permanent rollback could add $380 billion to 2025 global GDP, but warns that a cycle of crisis-pause-crisis keeps corporate boards paralyzed in limbo. Equity markets might enjoy a relief rally, yet big-ticket capital spending remains locked in the drawer. The first real tell arrives in mid-June when working groups meet in Beijing. If negotiators dare to tackle subsidies or force tech transfers, the odds of a comprehensive deal improve. Late July brings the U.S. Treasury's foreign exchange report. A weaker yuan could prompt Washington to brand China a currency manipulator and sour the mood. By day 75, 27th August, watch congestion reports from Long Beach and Ningbo because exporters may stampede to beat the deadline. Domestically, every new poll number matters. Should inflation or employment wobble, the White House could revive tariffs for electoral optics. Across the Pacific, President Xi's September tour of ASEAN will reveal whether Beijing is hedging by tightening trade blocs that exclude Washington. Did anyone truly win the latest skirmish? Perhaps the better question is, who bought time? 90 days isn't long in trade diplomacy, but it is long enough for companies to reroute shipments, investors to reprice risk, and politicians to read another batch of opinion polls. The core disputes, intellectual property, subsidies, supply chain dominance, remain exactly where we left them, only wrapped in bubble wrap until the timer dings. For American shoppers, shelves may look a shade cheaper. For Chinese exporters, assembly lines may hum a little louder. For the rest of the world, markets can catch their breath. Yet unless those deeper issues find daylight, the tariff yo-yo will snap back from ceasefire to crisis in a single headline. We'll keep the chess clock running right here on Nexusfeed. If you want clear-eyed macro insight with zero hype, hit the subscribe button. Click the bell icon to be notified when we upload, and let us know in the comments how the truce touches your corner of the economy. Thanks for watching, and we'll see you in the next one.